The most deceptive phase of any financial bubble is not the collapse. It is the moment uncertainty fades, prices climb, confidence feels earned, and caution begins to sound old-fashioned, not prudent, not disciplined, simply irrelevant. By the time people openly debate whether something is a bubble, belief has already hardened, not through manipulation or secret coordination, but through ordinary minds, slowly persuading themselves that the rules have changed. Welcome to the Wealth Casebook, where capital, influence, and history intersect, and where simple explanations rarely survive scrutiny. Every major bubble across history shares one unsettling feature. While it is forming, it feels sensible. It feels adaptive, even necessary. Participants do not think they are gambling. They think they are adjusting to reality as it evolves. That is why bubbles remain invisible from within. They never declare excess. They arrive disguised as progress, opportunity, and inevitability until consequences finally force recognition later. This dynamic is not new. It is deeply rooted. Long before modern markets, quarterly earnings, or algorithmic trading, people were already projecting future transformations onto scarce assets. In every era, the objects change, but the psychological machinery remains intact. In 17th century Holland, tulips were not merely plants. They represented prestige, rarity, and access to an emerging financial system. In the 19th century, railroads were not just infrastructure. They symbolized national ambition and industrial destiny. In the early 20th century, radio stocks were not just enterprises. They were participation in a new age of communication. In the late 20th century, the Internet was not simply a tool. It was framed as the elimination of distance, friction, and delay itself. Each of these shifts was grounded in reality. That distinction matters. Bubbles do not originate from fantasy. They originate from genuine innovation, extended far beyond what present economics can support. The force that carries truth into excess is psychological consistency. It begins with a fundamental human instinct: storytelling. People do not experience markets as equations. They experience them as narratives. Stories organize uncertainty. They create coherence where data alone cannot. A compelling narrative transforms complexity into inevitability. When such a narrative attaches itself to a new technology or asset class, belief becomes self-reinforcing. The story does not follow the numbers. The numbers begin to follow the story. Valuation ceases to function as a constraint and instead becomes a justification. Metrics that once defined prudence are reclassified as obsolete. Profitability is not rejected, merely deferred. Losses are reframed as strategic investments in future dominance. As conviction strengthens, mathematics becomes inconvenient rather than instructive. Social reinforcement accelerates this process. In environments defined by uncertainty, individuals instinctively observe others for cues. If peers are participating, abstention feels risky. If respected figures express confidence, skepticism begins to feel unnecessary. Markets intensify this instinct because price movement itself becomes evidence. Rising valuations are interpreted as confirmation that the narrative must be correct. Otherwise, why would capital continue to flow? Over time, doubt acquires social cost. Analysts who question assumptions are dismissed as pessimistic. Investors who hesitate feel increasingly isolated. Professional incentives shift. Career risk overtakes financial risk. Being wrong alone becomes more dangerous than being wrong together. From inside the consensus, behavior does not feel imitative. It feels validated. Once alignment forms, confirmation bias takes control. Information is still consumed, but selectively. Data that supports the narrative is amplified and circulated. Data that challenges it is reframed, contextualized, or quietly ignored. Models are adjusted to accommodate belief. Definitions are softened. Time horizons stretch. Language absorbs the strain. Words like temporary, cyclical, and long-term begin to carry disproportionate explanatory weight. This is the stage where belief becomes structurally protected. Any critique is interpreted not as caution, but as evidence that the critic fails to grasp the new framework. The narrative no longer competes with alternatives. It encloses them. Overconfidence follows, often unnoticed. Participation is rewarded. Early gains feel earned. Success is attributed to insight rather than environment. New participants believe they have identified an exceptional opportunity. Experienced participants believe they have improved their ability to manage risk. Nearly everyone assumes they will exit before conditions reverse, despite overwhelming historical evidence to the contrary. Favorable outcomes feel indistinguishable from intelligence until circumstances change. Authority endorsement completes the cycle. When large institutions allocate capital, skepticism erodes rapidly. Banks publish optimistic projections. Policymakers highlight innovation. Monetary conditions remain supportive. Liquidity remains available. The asset no longer feels speculative. It feels sanctioned. Stability becomes associated with institutional presence rather than underlying resilience. The need for reassurance is mistaken for proof of strength. Throughout this phase, nothing feels reckless. It feels synchronized. Prices rise, confidence expands, and caution recedes. Not because analysis disappears, but because questioning becomes emotionally uncomfortable. This is why bubbles rarely announce themselves. They do not resemble chaos. They resemble agreement. By the time excess becomes visible, it has already been normalized. The psychology that creates bubbles does not signal danger. It dulls sensitivity to it. Volatility blends into routine. Risk becomes abstract. The central question shifts from sustainability to positioning. Avoiding exclusion begins to matter more than evaluating exposure. This subtle progression is what separates contemporary bubbles from the dramatic images people expect. They do not require frenzy or spectacle. They do not depend on crowds abandoning caution overnight. Modern bubbles often develop quietly, shaped by institutions, benchmarks, and capital concentration rather than visible excitement. Participation becomes procedural. Assumptions go largely unchallenged, which leads directly to the present moment. Increasingly, investors are questioning whether artificial intelligence represents the early stages of another familiar cycle. Not because the technology is illusory. It is not, but because expectations surrounding it are expanding more rapidly than near-term economic realities can support. This distinction is critical. Every historical bubble was rooted in something real. Railroads genuinely transformed commerce. Electricity reshaped productivity. The internet permanently altered communication. The dot-com collapse did not occur because the internet failed. It occurred because markets priced immediate, universal, and perfectly monetizable adoption. Artificial intelligence follows a comparable trajectory. The tools are real. The efficiency gains are measurable. The long-term implications may indeed be profound. But markets do not price distant inevitability. They price present assumptions. And that is where psychology reasserts itself. In recent years, a narrow group of AI-aligned firms has accounted for a disproportionate share of overall market performance. Index returns have become increasingly concentrated, meaning fewer companies are responsible for the majority of gains. Concentration alone does not define a bubble, but it is a recognizable component. When capital flows funnel into a limited set of symbols, those symbols accumulate narrative significance beyond their balance sheets. Valuations rise not only because of earnings projections, but because dominance is presumed. Margins that have yet to materialize are treated as certainties. Heavy spending is reframed as strategic necessity. Profitability becomes something that will emerge later, after scale, after capture, after disruption completes its work. Confirmation bias reinforces this framing. Favorable announcements are amplified. Adoption headlines are celebrated. Less convenient signals rising costs, competitive pressures, regulatory friction are explained away. Skepticism is not engaged. It is labeled simultaneously. Authority bias deepens conviction. When major funds, index providers, and institutions allocate heavily toward the same theme, belief solidifies. Participation itself becomes proof. The question quietly shifts from valuation to exposure. Not what is this worth, but how risky is it to remain underinvested if momentum continues. This is the psychological transition that defines late-stage belief formation. It is not hysteria. It is alignment. An alignment does not require malicious intent. Most participants are not acting recklessly, they are responding logically to incentives, benchmarks, and professional risk. When lagging performance carries career consequences, caution becomes costly. Staying invested feels safer than restraint. This is how bubbles expand without enthusiasm. They do not need excitement. They need conformity. The common misconception is that bubbles collapse when participants collectively realize their error. That rarely happens. Bubbles end when a single assumption fractures. Revenue growth slows. Costs rise faster than anticipated. Financing conditions tighten. Whatever the trigger, once the core narrative loses coherence, psychology reverses abruptly. Confidence does not fade gradually. It breaks. The same forces that propelled prices upward accelerate the decline. Social proof inverts. Confirmation bias searches for negative signals. Overconfidence dissolves. Authority retreats. Liquidity thins. What once felt inevitable suddenly appears fragile. This reversal explains why bubbles feel obvious in hindsight and imperceptible in real time. Protection does not come from prediction. History suggests timing is nearly impossible. The objective is awareness. The crucial question is not whether an asset is in a bubble, but which assumption supports its valuation. If growth slows, what fails? If capital tightens, what changes? If expectations reset, what remains? When investments rely on narratives rather than cash flows, time becomes a liability. When valuations depend on flawless execution, patience transforms into risk. And when certainty dominates conversation, uncertainty deserves the greatest respect. History does not cycle because markets evolve. It cycles because human behavior remains unchanged. Bubbles do not emerge from ignorance or malice. They emerge because conviction feels more comfortable than uncertainty, until it abruptly fails. Those who endure are not the ones who predicted outcomes. They are the ones who examined their assumptions honestly. That is the lesson hidden beneath every collapse chart and retrospective analysis. If this sharpened your perspective, subscribe. History explains what headlines cannot fully alone.